Hi everyone, welcome to my channel. Today we are going to discuss the topic of forward rate parity. This is part of CFA Level 2 Economics Chapter 1. Before learning the concept of forward rate parity, it is important that you have studied covered interest rate parity and uncovered interest rate parity because forward rate parity condition builds upon the concept of covered interest rate parity and uncovered interest rate parity. We have discussed both these topics in detail. I'll give the link to these topics in the description. Please do watch them before watching this video. So, what do we mean by forward rate parity? Forward rate parity states forward rate parity states the forward exchange rate will be an unbiased predictor for will be an unbiased predictor for future spot exchange rate for future spot exchange rate. So this is the definition of forward rate parity, which is the forward exchange rate will be an unbiased predictor for future spot exchange rate. Now I'll tell why both covered and uncovered interest rate parity is important over here. It is because the forward exchange rate mentioned here, this is calculated from covered interest rate parity. This forward exchange rate is calculated from covered interest rate parity, and this future spot exchange rate mentioned over here, this is calculated from uncovered interest rate parity. Interest rate parity using the uncovered interest rate parity equation. That's why both these parity conditions should be satisfied for forward rate parity condition to hold. So forward rate parity states the forward exchange rate will be an unbiased predictor for future spot exchange rate. Now, why have they mentioned the word unbiased predictor instead of the word equal? It is because I'll first write down the equation for forward rate parity. So, forward rate parity equation given in the curriculum, forward rate parity equation is the forward rate here, it should be actually approximately equal, or it is like nearing the expected future spot exchange rate. So that's why we have used the word unbiased predictor, because it is not actually exactly equal. It is not actually exactly equal, but it is not actually exactly equal, but it is just like hovering around. If this is the future spot exchange rate, this forward rate would be hovering around this future spot exchange rate. So on an average, it should be nearly equal to the future expected spot exchange rate. That's why, but for the ease of calculation, we will use forward rate parity equation as the forward rate is equal to the expected future spot exchange rate. So this is the equation. Okay. and that's why the word unbiased is given. So it is not exactly equal, but it is nearing the expected spot exchange rate, expected future spot exchange rate. Now, we can understand how we derived this equation. So, to understand that, we would need to understand for both covered interest rate and uncovered interest rate parity condition. So here I'll write covered interest rate parity, covered interest rate parity. We know that from our video on forward rates, where we calculated the covered interest rate parity equation. From that, we know that the formula for forward rate is, it is equal to spot rate into 1 plus foreign interest rate multiplied with the actual investment duration divided by 360, the whole divided by 1 plus domestic interest rate multiplied with the investment duration. Now this is the equation for forward rate as per covered interest rate parity. Now, uh, another important concept about covered interest rate parity, it is bound by arbitrage. It is bound by arbitrage. Why? If you remember arbitrage, if you remember this forward rate that we had calculated, this is the rate at which no arbitrage profit opportunity is available. So this is a rate at which arbitrage profit cannot be made. Uh, so if the market price fluctuates from this, then arbitrage profit would be possible, and the investors, traders will quickly trade, make a riskless arbitrage profit, and the price will come back again to this forward rate. That's why covered interest rate parity is bound by arbitrage. Now we'll look at the equation for uncovered interest rate parity. Uncovered interest rate parity. Now, uncovered interest rate parity equation is the percentage change in spot exchange expected spot exchange rate is equal to the interest rate differential between the foreign currency and domestic currency. This is the uncovered interest rate parity conditions equation. Now, similar to how covered interest rate parity is bound by arbitrage condition, uncovered interest rate parity is based on the risk neutrality of investors, speculators, traders. So it is based on the risk neutrality of investors. Okay, now for forward rate parity condition to hold, both these conditions should be satisfied. So for forward rate parity condition to hold, both covered interest rate parity condition as well as uncovered interest rate parity condition should hold. So if both these conditions are satisfied, if both these conditions are satisfied, then only forward rate parity will hold. Then only forward rate forward rate parity condition will hold. And uh, so how can we derive the equation? So for this, first we have already seen the equation for forward rate. Now similarly, we had also derived the equation for forward premium or discount. That is, forward premium would be equal to forward rate minus spot rate. This was discussed in covered interest rate parity video, forward rate video. Now, forward rate discount or premium divided by this divided by the spot price will give us the forward premium or discount in percentage terms. Now, this should be equal to, I'll take the uncovered interest rate parity condition, that is percentage change of expected spot exchange rate, which would be equal to the interest rate differential between foreign currency and domestic currency. Okay, now based on this, so this is how we can derive the forward rate parity condition. Now this is also a part of forward rate. This is also a part of forward rate parity condition. And what do we understand by this? We can understand that first, the forward premium or discount on a currency, forward premium or discount on a currency, discount on a currency expressed in percentage terms, expressed in percentage terms equals the appreciation or depreciation of domestic currency, equals the appreciation or depreciation of domestic currency. Assuming that the uncovered interest rate parity condition holds. So this is from uncovered interest rate parity condition and this is from covered interest parity condition. Okay, we can understand this with the help of an example. So if I take the example of AUD to INR currency pair. Here AUD would be the foreign currency and INR would be the domestic currency. And if they have given the interest rate of AUD equal to 5% and interest rate of INR equal to 3.5%. Now, if I use the above equation, it would mean that uh, forward rate, forward premium expressed in percentage term expressed in percentage term, it should be equal to the percentage difference of expected spot exchange rate, which is equal to the interest rate differential. Now, if I use the above data, it will be equal to 5% minus 3%, which is equal to plus 1.5%, right? What do we understand from this plus 1.5%? It would mean that the first point, this side, it would mean AUD has higher interest rate. 5% is greater than 3%, right? So AUD has higher interest rate by 1.5%. Okay. Now the second point that we will understand, that is from this side of the equation, it would be INR would appreciate by 1.5%. It would mean that since AUD has a higher interest rate, it would mean the domestic currency INR would appreciate by 1.5%. Okay. And now the third part from the covered interest rate parity side for the our forward rate parity condition. The third point would mean that INR would, because this is positive, INR would trade at forward premium equal to 1.5%. Okay, so that's what we would be able to understand from this forward parity equation. This is the first part of deriving the equation. Now, based on that equation, we will be able to finally derive uh, our equation. Based on the above equation, we will be able to finally derive the equation, that is the forward rate would be approximately equal to the expected spot rate. The forward rate would be approximately equal to the expected spot rate, and that is the equation for forward forward rate parity. Okay. Now we know that for forward rate parity condition to hold, both covered interest rate parity and uncovered interest rate parity condition must hold. But actually, covered interest parity will hold because of arbitrage, because this forward rate is already calculated, and it is already, the investment is already hedged by the investor. Hence, covered, we know we know covered interest rate parity covered interest rate parity must must hold due to, because of because of arbitrage, and because the investment is already hedged. Hence, covered interest rate parity must hold. So for forward rate parity to satisfy, now the condition that should be satisfied is uncovered interest rate parity. Hence, for forward rate forward rate parity condition to hold, Uncovered interest rate parity condition must be satisfied. Uncovered interest rate parity condition must be satisfied. Now, for uncovered interest rate parity condition to be satisfied, what is the important point? For uncovered interest rate parity condition to be satisfied, it is dependent on the risk neutrality of investors, speculators. But we know uncovered interest rate parity is dependent on dependent on risk neutrality of investors, speculators, risk neutrality of investors. But in real world, actually, most of the investors are not risk neutral. Hence, uh, this uncovered interest rate parity condition does not hold in short and mid-term duration. In real world, most investors are not risk neutral. Most speculators are not risk neutral. And we discussed in the previous video that uh, uncovered interest rate parity condition does not hold in short and mid-term duration. Uh, hence, both hence, uncovered interest rate parity condition does not hold does not hold for short and mid-term duration. Short and mid-term duration. Therefore, because forward rate parity is dependent on both covered interest rate parity and uncovered interest rate parity, therefore, forward therefore forward rate parity condition forward rate parity condition parity also rarely rarely holds for short and mid-term term duration. That is, it means that forward rates are poor predictor for future spot exchange rate in short and mid-term. Forward rate poor predictor for future expected spot exchange rate in for short and mid-term duration. Short and mid-term duration. For short and mid-term investment. Okay, investment. Okay, but then why are we studying this forward rate parity condition? It is because even though it does not hold, it rarely holds for short and mid-term investment. Uh, it works better for long-term prediction. It works better for long-term prediction. Long-term prediction. Forward rate parity works better for long-term prediction, but it does not hold for short and mid-term investments or duration. That's all for today's video. In our next video, we would be discussing about purchasing power parity. Thank you.